Hello, property navigators. As you've probably already experienced as a property investor, investment data can overload our brains. Statistics and data points, the struggle of overthinking every little detail is very real. It's the one thing that remains constant. And let's face it, your brain could use a break from the never-ending game of mental gymnastics. Property investors often find themselves overthinking various aspects of their investments. Now, while it's essential for us to conduct thorough research and analysis, overthinking can sometimes lead to indecisions and missed opportunities. For an example, we have worked with a client recently who was looking to take the big dive into their first investment property. The reason he came to us was he was annoyed that after 5 months of searching and analysing the markets, he was still at square one. And what we discovered, he was just overthinking and overanalyzing these possible purchases in good markets. And this equated to a loss of $9,600 per month in growth. So literally, time was money and he was wasting it away. For investors to be on top of their game, we need to resolve anything that is unclear and understand how to shift our focus and energy into the most important aspects of the due diligence process. By focusing on what really matters, it can allow you to move more quickly when the right deal stacks up. And quicker acquisition times in a property market that is accelerating is key for short to medium-term equity gains that can be used to move on to the next deal more quickly and so on. All right. Let's rip into the top 5 problems that cause investors to contract serious brain blocker syndrome. Number 1, that the type of building material your property is built with will drastically affect the future potential value of your investment property. To answer this one, the building materials has very little impact on the performance of your investment property. Imagine this, you could have 2 properties that you could invest into, a brick and weatherboard home, side by side, same street, both in good condition, 4-bedroom, 2-bathroom properties on 600 square meter blocks. Do you think that if they sold at the same time, that one would be worth $100,000 more than the other based on building materials alone? Whilst brick is traditionally preferred to be a high quality building material, the question you need to be asking is, will this consideration of building materials drastically impact the future profitability of my investment property? Namely, the 2 building materials I am talking about here are brick and weatherboard. Now, you can pause the video here if you like to read what is on the screen. All building materials have advantages and disadvantages, and there really isn't much data available clearly showing one material impacting the profitability of an investment property over another. What you should be more attentive of is choosing higher land content over a preference of building materials. Because as we all know, our land content is the main appreciated component of the property. So, should you be worried about the maintenance costs when you are buying an investment property? 100% yes, you should be. And that means understanding exactly what these additional costs may be. Coming back to the question of must you choose brick over weatherboard? Well, the cost of painting the external of a weatherboard investment property might be around $10,000 every 15 or so years. This can be broken down into a cost of $660 per year. If you consider what a typical 500K property would be worth closer to 1.2 mil over this time, it really isn't worth stressing about. The lesson and key takeaway here is to always look at the bigger picture. Any investment that becomes rundown will result in high maintenance costs, whether it be brick or weatherboard. And remember, a building and pest inspection will make you aware of and allow you to determine any potential future costs prior to the purchase, allowing you to better understand if the deal stacks up. A deal shouldn't fall over based on an idea that brick is better than weatherboard or vice versa. And lastly, by limiting yourself and narrowing your search for properties to a specific type of building product, you are ultimately limiting the pool of opportunities, meaning longer acquisition periods resulting in higher prices being paid as property markets continue to push higher. All right, moving on to brain blocker number 2, understanding short-term losses. This is a big mistake investors can make, focusing on the initial loss and not the overall return. Now, as I touched on before, looking at the bigger picture is really important for an investor's mindset. Alongside interest rates peaking and holding costs becoming higher, to navigate through these possible short-term losses you may face, you need to take into account the overall profits, which include cash flow and capital growth of a property. All right, let's look at this scenario. Tony wanted to buy a single income dwelling in a market where asking rental prices hadn't yet caught up to the price growth of the suburb. But he only wanted to buy if the property was positively geared. This means that if the market Tony is looking in is only currently offering 4.6 to 4.8% yields, then they are dismissed by him. But you need to ask, what does this market look like in the next 12 to 18 months' time? What is your research showing about the potential progress of this property market's conditions? Is there continued demand pressures likely to be occurring in the rental and sales space? Is the economy looking to be on track for interest rates to reduce? Because these factors could swing a negatively geared investment property into a neutral or positively geared territory. Following on from this previous example, Tony wanted to buy a 600K property. That was his plan. But he didn't buy into the market because it had slightly lower yields. What Tony did miss looking at here was this area was at the start of its growth cycle, meaning he missed buying in an area that grew by 10% in the first year alone and missed out pocketing $60,000 in capital growth. For the sake of possibly paying an additional $150 per week to service the loan while it was negatively geared, Tony lost $7,500 in the first year, possibly around $5,000 after his tax write-off. So Tony has essentially missed out on $55,000 difference in capital growth. I'll ask you this question. Would you swap 5K for 55K if given the opportunity? Yes, but many investors just straight up miss it. All right, let's go on to brain blocker number 3, perfectionism. It's an absolute stone cold killer of stopping an investor from taking the first steps and subsequent steps. Are you a perfectionist when it comes to property investing? Overlaying an impossible amount of strategies and concepts that can lead to overthinking and overworking deals that make sense. Property is like a puzzle, different pieces coming together to make a complete picture. For example, some property markets offer stronger growth potential and lower yields, whilst others have stronger yields and lower growth potential. Some investors strive for the perfect investment property, seeking a flawless combination of location, price, condition, development potential, value add opportunity, yield, and potential for appreciation. It can be a daunting experience with so many factors to consider. However, it's rare to find a property that ticks every box perfectly. Instead of chasing perfection, investors should prioritize properties that meet their key criteria and have the potential for long-term growth. Perfectionism can be the result of a lack of strategy or having a proper understanding of your desired end goal. As an investor, you must understand how to put the property pieces together. In Monopoly, do you only buy the most expensive properties, or do you strive to obtain sets of properties to bring out their full potential? Strive to get started at a bare minimum. Get skin in the game. Don't limit yourself from starting or moving forward because you have a preconceived ideas about an investment property needing to tick every single box. There is balance that needs to be obtained. Strive to have a portfolio that gives you your desired income stream, not perfect properties. All right, rolling into brain blocker number 4, confirmation bias. This is when investors seek out a singular data point to reinforce and support their own assumptions. A single data point in isolation will not provide the secret detail into the workings of a particular property market. It must be weighted, correlated against a plethora of other additional data points and on-the-ground investigation. For example, if asking prices are increasing, this may look very good when viewed in isolation. But if this is correlated against days on market metric, which is also rising, well, this could signal a market that has reached its peak. Then, if you were to speak with agents on the ground, you might find that demand is also weakening on recent contract numbers and prices in real time. A really good piece of advice here is, don't start your research around a property market you either wish to confirm or deny. We're humans, we suffer from bias. I see time and time again property investors going out and letting their emotions affect their decisions instead of using cold, calculated thinking. Money doesn't care how you feel. A dollar is a dollar. Instead, approach your research using structure and an open mind. Know what you are looking for in the first place and have a plan. All right, brain blocker number 5, and a decent one that many investors get stuck on. Where do I buy? This question is not what investors should be initially asking, especially when it causes strategy and planning to come as an afterthought. The investor hasn't answered 4 key questions. Why are you investing? Do you need capital growth, cash flow, or a mixture of both? What is your goal? When will you buy? And this becomes equally important as timing markets for various reasons can be advantageous. And finally, now we can ask, where will I buy? This question can be answered by understanding the why, what, and when. Here are some other questions you definitely should be asking prior to where to buy. Now, let's pick on another imaginary character. This time, it's Ben. Imaginary Ben just focused on houses in capital city markets because he heard that strong capital growth would occur, but disregarded cash flows to focus solely on the prospects of capital growth. Ben had his eyes set on buying 5 properties, but at property number 3, he became stuck due to the banks not lending him more funds. Because of his poor cash flows and no ability to create more income in the properties that he had purchased. Ben's holding costs then increased, meaning that Ben had to liquidate his assets prior to them reaching their full potential. And this occurred because Ben was just focused on where, not why. Know the key investment results and match these to the property markets. Don't try and do it the other way around, as this can lead to you sacrificing your dream outcome. You may end up retiring with only 1 investment property, like 70% of investors, instead of 3 or more. I'll leave you with this tip. At a macro level, selecting the state, LGA, suburb to invest in is 80% of the job done, whilst at the micro level, 20% is in the selection of the property. Put the majority of your efforts into the 80%. And if you want to understand and learn more about this method, you should check out this video here. Until next time, happy property navigating.